We hope you enjoyed the course. Here's a quick reminder of some important elements. We identified that the objective of risk management is to prevent unwanted change. Islamic banks do this through a process of identifying, measuring, and controlling risk. We also dispelled some myths about Islamic banks, namely that Islamic banks are exposed to interest rate risk. Islamic banks can use financial instruments to transfer away some types of risks. Risk sharing doesn't mean risk seeking, and that Islamic banks are affected by turmoil in conventional markets. We emphasized some realities about Islamic banks and identified the following. Islamic banks do not aggressively speculate. They have limited opportunities to transfer risk. Financing is asset-based. Islamic banks face higher funding risk. Islamic banks are less leveraged, and that Islamic banks are better capitalized. We then examined if Islamic banking is safer than conventional banking. We identified that during the global financial crisis, the interconnectedness of financial markets created a contagion effect, which did affect Islamic banks indirectly, and this was down to factors such as tightened liquidity. We also identified that the difference between risk sharing and risk transfer is at the heart of Islamic banking, and that this is a key element to understand. We examined in detail how risk is lower for Islamic banks for some simple reasons. They do not use conventional debt. They have much lower leverage. They keep more capital. We also examined how risk is higher for an Islamic bank for other reasons. Operational risk due to Sharia non-compliance. The bank has fewer ways to transfer risk away from itself. The bank may have illiquid assets which can't be sold easily. The bank may have invested in too many assets that are very similar, and that, for some banks, not having a Sharia-compliant lender of the last resort. We then took a look at specific risks Islamic banks are exposed to and attempted to identify risks in common with conventional banks. Islamic banks are profit-seeking, and to generate returns, they must take risk. Most of an Islamic bank's risk is credit risk. However, they are also exposed to liquidity risk, market risk, operational risk, and legal risk. These risks are similar to those of a conventional bank. Perhaps more significantly, we identified the unique risks that Islamic banks are exposed to, such as the following: Sharia non-compliance risk, rate of return risk, displaced commercial risk, and fiduciary risk. It is very important to understand these unique risks and how they affect the operations of an Islamic bank. We then took a close look at what types of risks Sukuk are exposed to. To do this, we explored what Sukuk are and what mechanisms exist to mitigate risks. We identified that the risk of Sukuk derived from the risk of the underlying pool of assets. If assets are credit risky, then a Sukuk backed by those assets will also be credit risky. Unlike a bond issued by a conventional bank, Sukuk investors have recourse to the assets, rather than the Sukuk originator if things go wrong. Nevertheless, there are still strong economic ties between the originator and the Sukuk. We then looked at how Sukuk risks are assessed and discussed that most Sukuk are rated by credit ratings agencies, such as S&P, Moody's, and Fitch, and that the ratings agencies rate Sukuk in line with the credit worthiness of the originator. Lastly, we examined the difference between asset-backed and asset-based Sukuk, and that most Sukuk are classified as one or the other. This distinction is very important in assessing the risk of a Sukuk. We covered much more detail in the course itself, and this short video has only emphasized some key ideas. We hope you enjoyed the course and If you're about to take the certification examination, here's wishing you the very best of luck. See you again at Red Money Online.